Well, howdy there, folks. Welcome into this four-piece here today. 4 videos for me to react to. First one up here. Fear in the markets is not supported. So I want to react to that clip there from Bloomberg here today. Then I want to go ahead and react to this one. Recessions always start with an economy that's been booming. I think that's an interesting subject to listen to and kind of react to and give my opinion and perspectives. Next video up here. Big tech companies under pressure because they have no room for error. Not sure I agree with that, so we'll hear what she has to say, and I'll react to that and kind of give my opinion. And then last video up here, here's why Meta shares are sliding despite the earnings beat, which I'm definitely looking forward to getting into that one as an Meta shareholder, okay? Appreciate everybody joining me as always. Thanks so much, folks. New all-time high subscribers in the history of the channel. I appreciate each and every one of you for being here. After today's video's over, I will be hopping on to Twitch. So, yeah, if you haven't joined me on there, you might want to join me. We got the Amazon. Holy smokes. We got the Amazon conference call going on today after the bell. Sometimes it gets a little crazy on Twitch. We get yelling. You never really know what to expect. So there'll be a pinned comment down there if you want to join me on there.
You manage money as though things are what the data is telling you. And we keep talking about the fact that there's a recession coming, but every data point you've just given me is positive. GDP is in the 4s. I mean, for me, that is just a positive data point. The jobless claims continue to come out, and they're continuing to be positive and surprising you. So we're all focusing on the negatives. Companies are all cautious, and they're almost being told, don't be the optimist in the room. And as an investor, that's when you make money, is that when your opinion and what you're seeing is different than what consensus is.
So where do you make money right now? I mean, what's great about this, and of course the heritage of Franklin Templeton is the basic idea of you've got to choose recently active man.
So first off, she brings up a great point there in terms of looking at the data and basically being able to say, you know, where's this recession? And so, you know what it reminds me of? This is the market right now, and that investor psychology about recession. It reminds me of somebody who was like, I'm going to die. I'm going to die. I'm going to die. I'm going to die. Like, of course, like no different than we're going to have a recession someday, right? But the problem is no one can predict it. So it's kind of, it's not really worth worrying about, right? Kind of like death. It's not really worth worrying about because, you know, we'll all have our day, right? But it's not worth really worrying about. Because we don't know when it's going to come. It's going to come someday, right? The recession. You know, we can all freak out about a recession. We can worry about that every year. And by the way, the market does worry about recession every year. I've never been in the market where I haven't seen people talk about recession. Oh, I think a recession's coming next year. Oh, I think a recession's coming, right? At the end of the day, it's usually wasted time because you can't predict it. All the macroeconomists were all telling us recession was coming 2023. We never got it. So now it's pushed out 2024. If it doesn't happen 2024, 2025. If it doesn't happen 25, push it out to 26, right? And so at the end of the day, you got to plan your portfolio, protect yourself with some hedges here and there, but don't freak out about the recessions all the time, man. That's going to come. That's going to go. It's going to be what it's going to be.
It's been a challenge, but where is the opportunity given the correlated market I see this morning?
So I would look at our portfolio and say it's actually the most balanced portfolio in Mutual Global Discovery that I have seen since I've been managing it. And so we just have opportunities that exist across the markets. And you know, the benefits from us of being a global manager is I can go shopping in any market. So I can go shopping in Japan and pick up really good quality franchises there. And so that's what we're looking at, is where there's, you know, there's dislocations in the market, and where you've got a U.S. stock that trades at a premium to a good European or a good Japanese company. And so they're the opportunities that we're finding as active managers. But for once in my career, we're not seeing all the opportunities crowded into one sector. We're actually seeing them really dispersed.
How much can you really bank on a corporate model at a time where you have unhinged bond yields and a real uncertainty about what's behind that, given the fact that there are central banks selling, given the fact that there are shifting buyer bases around the world?
You know, it's interesting that, yes, we talk about the central bank selling, but actually the consumer is buying yield. It's the first time that they can look at their money market accounts, and they're making 5% on their money market accounts. They're able to go into the treasury markets and make real yield. So I think that that's where some of the money is going to come from. In terms of looking at those yields thing, you've got to think about it. What are the implications from a company by company basis. And actually, we've been talking for over 20, 30 years how low yields have kept all these uneconomic businesses in business. And so the rising bond yields potentially flushes out some of these companies.
That's
and
true.
what does that do for the remaining companies? It actually makes them better, and they can gain market share. So it's a good thing, some of these rising bond yields.
So let's get a little bit more specific. Yesterday,
It doesn't make the companies better. Let me be very clear about that, okay? It doesn't make a company better. Like, if you have no competitors, it doesn't make you better as a company. What it does do, and this is pretty magical, is it gives you more of a monopoly-type market share over whatever industry you're in if your weaker competitors go under, right? Because let's just call it, debt's a lot harder to take out, and it's a lot harder to raise money, so your company goes bankrupt. It just creates companies into more of a monopoly position, which then in turn means those companies become much more profitable, right? So there's a difference between like a company becoming better and a company becoming more profitable, right? Because competition makes actually companies much better companies.
Came out. They had better than expected earnings. It was a good report. And then on the call, they said, we are very subject to volatility of the macro landscape. The revenue outlook is uncertain for 2024, and the shares tanked. People were looking for reasons to sell. Are you coming in and buying?
Everyone is looking for reasons to sell everything. If you look at the regional banks, a similar type of commentary happened. If there was any type of negative commentary on the fourth quarter NIM, the stocks all tanked as well. So you're exactly right. Everyone keeps looking for these negative data points. But if you stand back and if you were objective and didn't put labels on this, and I was to give you some of that data in terms of what we're seeing on the job market in particular, you would be bullish. I mean, people are employed. Companies are still struggling to find labor. So even though someone like a Meta, has gone through layoffs in the past, probably a little overstaffed and just taking that down to normal. And those comments, though, do put fear into the market that we don't think is supported by the real action of companies.
Well, let's talk about that fear, because the pushback there would be, okay, you have a still robust, a still hot labor market in particular, but you think about what that could mean for the Fed and that last leg to get inflation back to 2%, that they're going to have to tip the economy into a recession to do that. So how are you thinking about that risk and balancing against your portfolio?
I don't think that they need to tip their economy into recession in order for you to get the inflation number down. I think that the first thing we need to recognize that inflation is really a backward-looking measure, and the Fed has forward-looking models as to where they think the market is going. And so I think that the comments that they're coming out and talking about higher for longer is really informative. They are also not talking about rate cuts, and we are not expecting rate cuts to come. So in terms of the narrative,
I don't think people have much faith in the Fed models. I don't even know if the Fed has much faith in the Fed models in terms of where they're going to be even 6 months from now, never mind a year from now.
the Fed is not looking to tip the market into a recession. I think that is the bad case outcome in this situation. I think that they're just trying to make sure the economy's got enough support to kind of get through this and to muddle along.
And Katrina, you said that you could go anywhere right now. You could go to Japan. Are you? Are you going international?
Yes. We have increased our weighting in Japan significantly.
Okay, so let me address something here, okay, that I think is really important. Why are people looking to sell? There's two core reasons why people are looking to sell, in my personal opinion, okay? The first reason is what we spoke about before, right? The recession talk. Oh, recession. The second reason is treasuries. I believe there's just a lot of people that are looking at that 5.5% you can get on, all these different treasuries, all the way from 2 year, 1 year, 6 month. I think there's just a lot of people that are like, dang, man, I could get around 5.5% right now. Why don't I just put some money in treasuries? And so I just think there's a lot of people that are just looking for that exit door and looking for anything to give me the reason, any reason, so I can sell and go and hide out in treasuries. And that's just where the market seems to be at right now, folks. Next one up here, recessions always start with an economy that's been booming.
Take a look at growth versus value in that debate. Growth has outperformed value in the last decade. Is there a case to be made for investing in value at these levels? Joining us this morning here at Post 9, Research Affiliates founder and chairman of the board, Rob Arnott. Research Affiliates, the only sub-advisor to PIMCO. $130 billion is managed globally using its strategies. It's great to have you in. Thank you.
Wonderful to be here. Thank you.
What did the GDP number and the core PCE print say to you today?
Basically, none of it comes as a surprise. We're in an economy that I think is going to be showing signs of slowing. We have housing. There's no such thing as a recession without a housing slowdown. There's no such thing as a housing slowdown without a recession. They're joined at the hip. And so right now we have a housing market that's severely restrained. If you have a home and a mortgage at 2.5%, you're not going to sell unless you have to. If you want to buy and you're going to have to borrow at 7.5%, you're probably not going to buy because you can't. And so supply and demand are both constrained, which is what allows home prices to remain high. That can falter if there's any sort of move towards equilibrium. And so we've talked in the past about inverted yield curves predicting recessions. I think they cause recessions. And the yield curve inversion set the stage for the housing issues we're facing now.
Right. Are you taking any solace in some of the high-frequency data that shows maybe supply is beginning to bottom here?
I take some comfort in that. I also take comfort in the fact that you have 2 job openings for every job seeker. People will say that recessions don't start with a booming economy. That's not true. Recessions always start with an economy that's been booming. It's the nature of the peak and the rolling over. So I view the coming year as one where the bond market is signaling caution. The stock market is shrugging off a lot of that.
So I want to, I've made this, one of those big birds out there. I want to make this point because I just think it's so important because I don't hear anybody talking about this other than me. And I'm like, guys, I think this is really important. Okay, listen, there is a realistic possibility that the consumer could actually get in a much stronger place in 2024 than they've been in 2023 or 2022 for that matter. If inflation is not a problem in 24, people still have jobs and are getting nice raises, and obviously you see what's going on with the unions and the strikes and all that, and people getting some big wage bumps, we could see real wages pick up significantly in 2024. That's a scenario that no one outside of me is talking about. And I'm like, guys, this is important. Like, I think this should be talked about a lot more, and I think this should be a scenario that's considered. Everybody's considering recession, everybody's considering soft landing, medium landing, hard landing. And I'm like, have you guys considered the scenario where people actually keep their jobs and 24 is actually a phenomenal year because real wages go like this because inflation's not a problem and people are getting nice wage bumps? So that's a scenario that's not getting talked about enough. And, obviously that would be a phenomenal thing for the economy in 2024, right? That would be a phenomenal thing for corporate earnings in 2024. And it would actually lead you into probably a decent 2025 as well. So that's a scenario that has to be considered, but just people aren't considering it.
And in any given year, the normal risk of recession or bear market is about 20%. For the coming year, I'd say it's about 50-50.
So buy bonds. Is that your message?
No. Bonds, I think, are much more attractive than they were at lower yields, obviously. Stocks, I think, are vulnerable. U.S. stocks, specifically U.S. growth stocks. There's a couple of headwinds that play against growth and in favor of value. One of those is relative valuation. When the spread in valuation between growth and value gets enormously wide, any mean reversion will work in your benefit if you're a value investor. Secondly, inflation is good for value relative to growth on 2 counts. Firstly, there's no such thing as high but stable inflation. If you have high inflation, you have elevated market volatility, elevated macroeconomic volatility, elevated uncertainty. Those all work in favor of value because people will start to look for a margin of safety. Margin of safety isn't available in assets where you're buying a future that's 10 or 20 years out. It also plays into value in the sense that higher elevated inflation sustains higher bond yields, and we've seen that play out hugely in the last 18 months. Higher bond yields mean a higher discount rate for long-term future growth, which reduces the value of growth stocks relative to value stocks. The same applies for small versus large. Small stocks are cheap. The same applies to non-U.S. versus U.S. Non-U.S. stocks are cheap relative to U.S. stocks.
True. Those are all good points. I can't really debate with any of those, to be honest. And, you know, if you ask me, what groups of stocks are cheap right now in the market? I'll tell you this. Dividend stocks, cheap right now. The cheapest many of those stocks have been in a long time, and we're talking many years, okay? Value stocks, same thing, in the same category as dividend stocks. Small cap stocks, incredibly cheap right now, probably going to continue to remain very cheap in the very short term here. And eventually that will break, and, you know, smalls won't be cheap forever, but they are very cheap right now. And also, believe it or not, there's many of the big techs, the Magnificent Seven, that are actually trading very cheap right now. You can't look at Google stock, look at those numbers they're reporting and say that's an expensive stock. No, it's a cheap stock right now, Google is. You can't look at Meta's numbers and say that's an expensive stock. No, that's very cheap, and we'll talk about Meta in just a moment. So, you know, even NVIDIA, you can't even say NVIDIA is an expensive stock right now. Look at NVIDIA's forward P and tell me that's an expensive stock when they're putting up the type of growth they're putting up. That's not even an expensive stock. So, you know, there's a lot of deals out there. That's why this is the sort of market you got to start working with a lot of urgency.
A lot of pressure this morning on the back of the Meta report, citing some weakness in ad spending due to the Israel-Hamas war right now. What's your take when it comes to mega cap tech and the impact on the broader market?
Yeah, I think your first guest, Arjun Kapal, said it perfectly, which he said there's no room for error. And so what I've been thinking about a lot is stocks with room for error versus stocks with no room for error. And that's really, I think, the problem with these mega cap companies, because the numbers they're reporting are spectacular. But when you're up 150%, or when you're trading at 30 times earnings, there's no room for error. So I've been thinking that whole no room for error, it's not just valuation. It's either how much the stock has run up in anticipation of these great numbers or what the valuation is. And so I think there's been too much hope in them all year.
Well, Jenny, as you know, this is the busiest day of the earnings season. With that in mind, what's your WEX word of the day?
Yeah. Inflection. And it goes straight back to that. I think that we're at an inflection point in terms of market leadership. And then actually Guy said something about this too, where he was talking about Amazon's valuation Amazon's results. And he was saying something about November 2020. And I look back to that September 2020 and think about how that was also an inflection point for the market leadership. And it was pretty significant. So from the fall of 2020 until SVB this year, those big guys lost their leadership. They still did well, but they weren't the leaders. And I think that we're at another one of these inflection points right now.
All right. So I know you own Meta. We also saw Alphabet report, and we have Amazon coming up. What we saw from Meta and Alphabet, how does that make you think about this Amazon report after the bell?
It makes me nervous for Amazon.
Oh, really?
Because I just don't know, again, when they're up this much, like, what can you do? I was trying to explain this to my daughter last night, and it's really hard, to say, okay, but they just had revenues up 34% and this down 3%. That doesn't make sense to the average. How
do I feel going into these Amazon earnings? Am I nervous? The answer to that is absolutely not. 0% nervous about these Amazon earnings. The stock's already sold off on the back of the Qs and the NASDAQ and everything selling off, right? On top of that, we already have seen Visa numbers, very strong. We've already seen Google numbers, very strong. We've already seen Meta numbers, very strong. We've already seen Microsoft numbers, very strong. I'm 0% worried about, oh my gosh, what's going to happen here with Amazon? Absolutely not.
But it's all that anticipation, and there's just too much in the mega caps. I mean, what are they up, Frank? Like 55% collectively year to date or something? They're 50+% of the S&P's total return. They're all trading at valuations that are, I think, 6 multiple points or more, maybe closer to 10 multiple points ahead of the other 493 stocks in the market.
Okay.
There's a disconnect in valuation.
All right, I want to get to our mystery chart. It's one of your picks of the day. We're talking about Verizon. Just came off earnings a few days ago. What has you liking this stock right now, also in a higher rate environment?
Yeah, there's so much room for error, right? They've got a 8% dividend yield. They're trading at 7 times earnings. They were up 9% after their earnings call. And all they did was say like, oh, hey, we're going to raise free cash flow guidance a little bit. We're going to lower CapEx a little bit. And the consumer's still competitive, but not quite as bad. You know what their earnings are going to grow at? I don't know, maybe 2% a year for the next couple of years. Their dividend is going to grow also at about 2% a year for the next few years.
Well put.
When you can say that and see your share price go up 9% because there's so little expectation for anything, I think this is where you want to be right now.
All right, so
100%.
one other name I want to talk to you about, American Express. That's your other pick. We're seeing a slowdown in consumer spending, and you're saying now's the time to buy this stock?
Yes, and very specifically, because what's interesting is if you look at American Express and what they reported versus, say, Discover Financial, what you see there is both stocks over the past few months are down about the same. They're down about 17 and 20%. But meanwhile, American Express is only seeing 1.2% of credit card loans in excess of 30 days. You're seeing Discover at like 3.4% of loans in excess of 30 days. You've got American Express trading at 12 times earnings, and they're guiding for double-digit, actually like mid-teens earnings growth through 2024 and beyond. So what you have here is that over-concern, that intense concern about the consumer pressuring all stocks in the same way, when actually you need to start to sort through and say, hey, some of these are different and some of the...
Yeah, I mean, if you had to tell me American Express or Discover, American Express any day of the week, different clientele base. All right, time to get into this Meta one.
Meta this morning, despite weakness of softness in the ad market. Our next guest keeping his outperform and his 385. Joining us at Post 9 is Oppenheimer's Jason Helstein. Jason, great to have you. Thanks for coming in. We had a big discussion this morning about whether or not there was enough evidence last night that you could get to $20 in 24. Is that the crux of the debate?
I mean, really, I think it was making people more concerned that if the Middle East turned into something bigger, that would have an impact on advertising. Snap had put that out there, but I think investors didn't believe that because they have some of their own issues. And then to the extent you got a guidance range that was, 13 to 24% growth, that's unusually wide. When pressed why that low end, they did mention the Middle East. And so I think that was just something that investors were not really focused on before today.
Meanwhile, as for the revenue growth and the operating margin, is that a reflection of the hard decisions they made a few quarters ago?
100%. I mean, you look, they Reels got to revenue neutral in 2 years. It took Stories 3.5 years. They quoted a 70% improvement on engagement, 40% engagement from Reels. And then
the important thing to remember about Reels, folks, if you want to think about where Meta's business model is going here in terms of the financial front, Reels is extremely early days in monetization. So they got a long runway of ramping up monetization when it comes to the Reels opportunity and those short form videos. So that is something to keep in mind that's going to be very bullish for Meta over the next several years, not just next several weeks or months or quarters.
7% improvement on core Instagram and Facebook from AI. So clearly the investments that they're making are driving engagement. And then you can see the revenue numbers, right? Obviously coming off of the Apple privacy changes.
So why is the stock down 6%? Is it really all just on this worries about the ad market?
I think it is. If you look at all the other ad stocks today, they're all down, maybe not the same magnitude, but everything connected to digital advertising is down today. And again, Snap said it. There wasn't a focus. Meta said, and I think this was a little bit Powell-esque. I think it was a bit over-talked. I don't think they're seeing it right now, but they're giving themselves cushion just in case things don't, go in a favorable way.
Did you get a sense, and operating expenses came in at least below what many were worried they would hit, and but cost discipline, is the year of efficiency going to be years of efficiency?
Well, I think the bears were worried about expenses over $100 billion. They're guiding 96 and change. That's where the street was, so they're kind of hitting that. Yeah. And again, historically, they use expenses as a way to kind of manage the earnings. And so presumably they'll chip away and that, they'll come in below 96 next year.
So you think they continue to be focused on efficiency?
I think so.
You believe them?
Right. They did talk about shifting people within the organization, a backlog of hiring, but I clearly think like Mark, look, this stock is now trading at 14 times 25 earnings, right? I mean, that's a crazy low multiple. And so I think like Mark knows what he needs to do.
What I mentioned AI with IBM, breaking it out. What did we learn about generative AI driven advertising and when that's going to be material?
Yeah, I mean, look, right now it's more like the AI changes the font, it changes the background. It's not creating the digital image yet, but at their Meta Connect Day, they did show a product that isn't live yet that can create an image in 5 seconds. And presumably, that's the precursor to AI-generated ads, maybe back half of next year, but we don't know yet.
We'll look out for Amazon tonight, Jason.
So what did Zuckerberg basically say on the conference call that was extremely important? If you're worried about Meta's cost, efficiency, anything like that, what Zuckerberg basically said is he called out how the company is, with smaller teams and the way they're running now at this point in time, they're able to innovate much more quickly. So for me, I don't think they're going to go on some crazy hiring spree. I believe they're going to hire always, try to find the best of the best to come join Meta, right? But if you're thinking about, is Meta going to go on some crazy hiring spree, I just don't see it anymore. Because it seems like Zuckerberg's very happy with the level of engagement in the employee force and how fast they're able to innovate with smaller teams versus bigger teams and being much more bureaucratic, right? Which is a problem that leads into a lot of big companies. And I think he saw what Meta could be when they did that, and he sees what Meta is now, okay? I got to get this video out, then I got to hop on Twitch. If you want to join me on Twitch for the live stream, Amazon conference call, Amazon earnings, Enphase earnings, Chipotle, and Intel as well, all here after the bell. Obviously, Amazon's the big one. So appreciate you guys joining me as always. Much love and have a great day.